Welcome back. Now, between April and May, inflation is unchanged at 5.2%. The main contributors to the print are housing and utilities, miscellaneous goods and services, transport, and food and alcoholic beverages. Gina Schoeman, who's economist at Citibank, joins us with her analysis of this print. Gina, an absolute pleasure. Good afternoon.
Good afternoon. How are you?
Wonderful. Thank you for being with us this afternoon.
Absolutely.
Gina, I want to speak about this 5.2% print. It feels like we're in a rut. I'm keen to get your thoughts here.
Well, I've got some good news for you. Yes, it is at 5.2% year on year, and that's unchanged, and we prefer to see it coming down. However, given the performance of the currency so far, and that's actually a very good thing post-elections, it does look as if the outcome of the government of national unity is something that's sitting very positively with financial markets. And so if the currency continues at its current levels, we're likely to see quite a nice July petrol price cut, diesel price cut, and that's going to help enable inflation to come down. But let me just also add that even before that, even if we were still back at the currency being somewhere around 18.50 against the dollar, we were even then still going to trend towards the 4.5% midpoint target of the South African Reserve Bank by the end of the year. So yes, not much has changed on the inflation front right now, but I think if anything, we'll definitely be heading much lower by the end of the year, and potentially, depending on how our political situation goes, maybe even lower than expected.
I thought it would actually be fantastic, because what we also know is the fact that globally this picture is a bit mixed now at this point, isn't it, Gina? We see one picture in Europe, one picture in the United States, and then you have us developing nations who are trying to, of course, protect our currencies, but also protect our economies. And of course, our economies are much weaker than there. And I think it's a very tricky balancing act for the Reserve Bank, but also just for people like you and me who are just trying to get by.
It's a very, very tricky balancing act. And it's always difficult for the South African Reserve Bank because, of course, interest rate cuts help everybody, right? It makes your debt much cheaper. However, inflation hurts too many people as compared to how many people interest rate cuts actually benefit. And inflation also has far-reaching negative effects in other parts of the economy. In South Africa, the best way to describe it is that, yes, we have not grown very strongly up until this point. So it's not so much that that is creating inflation. However, we have proven to be an incredibly inefficient country, and inefficiencies create inflation. So if you're inefficient at producing electricity, you're going to have to charge people more money in order to produce it. So that's a very easy example of how inflation is created. But again, however, we all know that load shedding has reduced substantially. I mean, we haven't seen it for so long now. It could come back during the winter season, not just because it's post-election, but just because demand goes up. But that doesn't mean that that's going to become a bigger inefficiency than before. So where I'm really going with this is that if we trend forward in South Africa, yes, all of us economists, I think the consensus is that growth this year from 1% should move upwards next year to 1.6% or 1.5%. But that doesn't mean that inflation necessarily follows. It could mean that the efficiency gains from reforms, which is why it's so important they continue, actually help to pull inflation lower. So by the end of the year, we've got 4.4% as an average for the full quarter. Beginning of next year, it goes up mildly to 4.6%. But we don't have the kind of numbers that we're currently seeing 5.2% on the card, unless, and there's always the big unless we see something very negative happen in currency, or of course also in commodity prices, usually from a supply side shock. So we were all very concerned about El Nino at a point, but food is very comfortably trending downwards, and we'll keep our eye on that, but El Nino is now finished. And so La Nina will pull in, and we obviously will monitor it very closely, but there's nothing on the horizon that makes us believe that inflation is going to be able to pull back to level 5 or above. We think 4.5% is very comfortably on the cards.
That is very comforting. And there's also arguments here that we've heard about South Africa being in a stagflation, a bit of a place here, of course, that's characterized by high unemployment, low growth and high inflation. Are we really, is this too extreme of a prognosis?
Not for South Africa, I would say. So I think in South Africa's case, all thanks needs to go to, again, the South African Reserve Bank, which, yes, is hawkish and, yes, is very strict on inflation. But by doing so, they're protecting everyone in the country from inflation eating away at their incomes. And we know that this impacts the poor more than anybody else. And that's obviously even the biggest part of our population. So we would be in far more dire situation if we allowed inflation to pull away from us. And it's because the SARB is so strict, because the SARB tries to keep and contain inflation around that 4.5% midpoint target, that you can't really describe South Africa as a stagflationary country. We might have lower growth than what we want to achieve, but we are ensuring that inflation remains within the target that we have currently set.
And, before then I let you go, I also want to then touch on issues around commodities, which you touched on here in South Africa. And of course, referring to soft commodities, but even with hard commodities, their contribution to the economy at large, with it bottoming out, I'm hoping we're at the bottom of the cycle. What would that do for us in terms of maybe inflation and maybe even in terms of growth?
Well, actually, that's very beneficial. Because we export a lot of hard commodities. So, we're very good at our minerals. And if those prices trend upwards, it actually means we're going to collect more export revenue. And that export revenues means our terms of trade position improves. And as soon as your terms of trade position improves, not only do you run a very small current account deficit or marginally positive current account surplus, and that means you don't need as much excess financing. And obviously, in the end, that comes down to your currency. Your currency is able to remain stronger, or at least that part of the currency strength is able to offset any other potential currency weaknesses, such as any risk premium that might be placed on South Africa because of political uncertainties, etc. But again, I would stress that right now, the markets have decided that that risk premium is smaller, and we're seeing the positive impact on the currency as a result.
Well, great to have a more optimistic conversation around this one, Gina. Thank you so much for your time this afternoon. That was Citibank economist Gina Schoeman.